Hi, an ideal investment should have 5 attributes. 1. It should give decent returns. Second, it should generate good capital appreciation. Third, it should be safe. Fourth, it should be liquid. That means it should be capable of being converted into cash at short notice. And 5, it should be tax efficient. There are very few asset classes which have all these 5 attributes. Stocks and equity and hybrid mutual funds have all these 5 attributes. Indian stock market has performed exceedingly well, beating all other asset classes during the last 40 years. In 1979, Sensex was 100, now it is around 38,000. This is a compound annual growth rate of more than 16%. An investment of 10,000 rupees in Sensex stocks in 1979 is now worth 38 lakhs. This is phenomenal wealth creation. Unfortunately, a large number of retail investors, perhaps the majority of retail investors, have not benefited out of this wealth creation. High net worth individuals, very serious intelligent investors, and investors who have been investing through the mutual fund route have benefited substantially, but retail investors, many of them, most of them have not. There are 2 reasons why retail investors have not benefited out of this wealth creation in the stock market. We will examine these 2 broad mistakes. First mistake which retail investors commit, a major mistake, is the wrong timing. Retail investors enter the market normally at the peak of a bull market. When the bull market is at its peak, when the valuations are very high, there will be headline news in the media about the bull run in the markets, the huge returns that the market is generating. This attracts a large number of retail investors into the market. And unfortunately, these investors who enter the market at the peak do not buy quality stocks, they buy low grade stocks. And when the market corrects, as it inevitably does, bull market cannot continue forever, there will be sharp corrections and the low grade stocks will be slaughtered in the market correction. Therefore, this is the big mistake which retail investors commit: wrong timing, entering at the peak of the market and exiting at the trough of the market. The second point, the second mistake, as I have already referred to, is a wrong investment decision regarding the quality of stocks. If we look at the portfolio of an average retail investor, we will find that blue chips are conspicuous by their absence. It will be very difficult to find good quality stocks dominating the portfolio of as usual an average retail investor. Retail investors go after low grade stocks, at least in the initial years of their investment. Low grade stocks, which are called cats and dogs in stock market language. They are under the impression that, retail investors are under the impression that if you buy a 3 rupee stock and if it appreciates to 6 rupees, you get 100% return. Though this is a major mistake which retail investors commit. They go after low grade stocks, and low grade stocks will never bounce after a market recovery. If you buy a good quality stock, even if the market corrects, the investor need not bother it at all, because when the market rebounds, these good quality stocks also will rebound. So these are the 2 major mistakes. So to summarize, to be a successful retail investor, what should a retail investor do? Number 1, retail investor should not try to time the market. It is almost impossible to time the market. Instead of entering the market at the peak, exiting at the bottom, a retail investor should try to invest through the ups and downs of the market, so that the average cost of the investments will be very low. This is the advantage of systematic investment plans also in equity mutual funds and hybrid funds. Therefore, don't time the market, invest through the ups and downs of the market, invest for the long term, not for the short term. And more importantly, a retail investor who wants to invest in the market directly by choosing stocks directly should have expertise to invest. If a retail investor does not have this expertise to choose stocks on his own or her own, then the ideal investment strategy should be to avoid a direct investment and invest through the mutual fund route. Another big mistake which retail investors commit and lose a lot of money in the bargain is by reckless trading in the market. Investing based on tips and reckless trading in the market. Trading is a highly risky investment activity, and successful traders are professional traders who operate with a strict stop loss. Retail investors will find it very difficult to do that. Therefore, trade in the market only if you have the expertise to do that, otherwise avoid trade. Therefore, to be a successful investor, invest in good quality stocks if you have the expertise to invest. Invest through the mutual fund route through the systematic investment plans if you don't have the expertise to invest in the market directly. Invest for the long term and don't trade recklessly. This kind of investment will certainly fetch very good returns in the long run. So invest systematically and grow rich. Thank you.